A moderation in growth and a mandate to target headline inflation was reason enough for 4 out of 6 Monetary Policy Committee members to advocate a rate cut. The minutes of the February MPC meeting show that the other 2 members are still concerned about core inflation. Remember, it was also the first policy under Governor Shaktikanta Das. So how should we be reading these minutes of the last policy meeting? Saugata Bhattacharya, Chief Economist at Axis Bank, joins us on the phone line. Saugata, thank you so much for joining us indeed. What have you made of the minutes and particularly of those who've shifted stance?
Well, yes, definitely. Reading the statements of all the members, the MPC members, obviously, particularly the people who voted for a cut at this point in time, seem to suggest that growth had become an overriding concern. And this is something that Governor had indicated even in his post-policy statement, that given the fact that inflation looks to be sustained at a low level, time to act decisively to stimulate growth. So that's pretty much the summation of what the members talked about. And the fact that all the members uniformly deemed that growth was slowing down sufficiently enough to at least warrant a change in stance. So now the question, of course, is how much is there a real growth slowdown, or is it just a matter of sentiment? More than a growth slowdown, and what are the risks which lie ahead in terms of a quick revival of growth?
Which is precisely my question, Saugata. I was surprised to see the number of times that this reference to slower growth was made, at least in the data available to us so far. We haven't seen a dramatic slowdown or an unanticipated slowdown. And the global growth concerns that have been flagged off by at least a couple of members, what is going to be the impact of that on domestic growth? Should we expect to see it, for instance, in the Q3 numbers or the Q4 numbers?
So, a couple of points on what you talked about, Ira. So one thing is global growth is, particularly in Europe and probably even in China, although not probably as evidently in the US at this point in time, global growth is slowing down. The PMI numbers, the Germany's car sales, the trade wars, the fears on Brexit, other problems in Europe, definitely. But on the whole, I think a global growth slowdown is probably, as has been mentioned also in the minutes, a global growth slowdown is on the net a beneficial to India, particularly through the channels of crude, which is likely to be relatively moderate. So that's one. The second point that you mentioned is what are the signals of this growth slowdown? So till now we have seen signs. Some consumer durables, two-wheelers, passenger vehicles, etc., having slowed down. Probably credit flows also having come down a little bit, although we haven't seen the formal numbers yet in the growth slowdown. And particularly fears of this credit squeeze causing a further slowdown, if not in Q3 numbers, in Q4 and beyond. So those are issues, but my sense, as you mentioned, I think this is more to do with the sentiment rather than actual numbers. But you never know, because the numbers are backward-looking, mostly Q3 numbers. What portends ahead for Q4 is something that we need to understand better.
So, Saugata, what would the inference that you'd be making from what we've seen in the MPC minutes? Particularly with respect to rate action, is this going to be, was this a one-and-done policy, or is this going to be a beginning of a prolonged rate-cutting cycle?
No, so it's not a one-and-done, most certainly not. And our own forecast, inflation forecast, and we have been wrong before on this. So our own inflation forecast, the average for FY20 next year, that is to say, is currently at 3.4%, the CPI headline inflation, which is relatively very, very low. So even if there are upside risks, oil goes up to 70, whatever else happens, corporate pricing power comes back. So it's difficult to see that inflation will cross 4% in any sustained manner. So if that actually is also seen by the MPC going forward, there is plenty of room for cutting rates. We definitely expect another rate cut in April. Beyond that, I'm not very sure because there are so many sources of uncertainty that will come in with the rains, with the elections coming in, how much they can pull in. But if the growth numbers, if we are still growing at about 7.2%, or maybe even less, and if inflation continues in this low trajectory that we have seen, then my sense is that, I mean, there is space for deeper rate cuts. I mean, we are factoring in, as of now, 50 with including the 25 that we have already seen. But maybe, I mean, if this growth inflation trajectory continues in the way that we now see, I'm sure, I mean, given the high real interest rates that exist now, rates can easily be cut in another 50 basis points.
Another 50 basis points. On the flip side, Saugata, I mean, if you look at, I think Bhattacharya sort of alluded to it. He didn't use the terminology as to, what is an appropriate neutral rate for the economy. He talked about the fact that maybe 6.5 is a medium-term, rate that would work in the current growth inflation dynamic. But you're saying that that's not the case. Lower rates would be justified even if we're looking to maintain and contain not just inflation, but inflation expectations around 4% in the medium term.
I would think so, because, I mean, it's really, really difficult to take a call on what a neutral rate is, because that would depend on your potential growth, where we are relative to potential growth, how the potential with coming in with capacity utilization increases, inching towards growth, actually inching towards the potential growth. How much of corporate pricing power comes in, that would impact core inflation, together with the other risks in the system on food and fuel that begins to take headline inflation up. So any of these can happen. But to my mind, as of now, the chances of that, all of those factors coming in together are relatively, I think, a tail risk. Of course, I mean, these might be the last silly words that I've said. But I think as of this point in time, a 6.5%, which is essentially 2.5 percentage points higher than the expected inflation rate, maybe even higher. So that seems to be a little too high, given our current understanding of growth conditions.
Okay. Saugata, I have one last question, a specific one. Sorry to put you on the spot, but I think, everyone was waiting to understand how Michael Patra explains his change of stance. He's been seen as one of the most hawkish members. I was very intrigued by his statement that it is prudent to preserve sufficient policy space to insulate the economy from adverse external shocks and boost the domestic economy in an opportune manner rather than deplete it in haste. What did you read into that statement, Saugata?
So one, of course, I mean, it's great English. That's one. Secondly, I think the argument that you've also heard before, that maybe you want to lower rates now so that when and if a problem strikes or is the need to hike rates, you can actually hike rates going forward so that you have that space built into this. So that I presume is where he's coming in from.